Well, good afternoon, everybody. I'd like to welcome you to Landis and Associates' continuing series of Engage Economy webinars. My name is Rich Landis, and I have the pleasure of being one of your presenters today. Also joining us is Karen Quigley, who heads up our business tax area, and Gail Mowery, who leads our individual tax area. So I see Gail there. Karen, are you there? Okay.
Here I am.
All right, good afternoon, ladies. And we also have Crystal Eisenhower, she's our COO, and she will be monitoring the questions that come in today. The questions can be submitted by clicking on the Q&A icon at the bottom of your screen. Now, you might have to hover at the bottom of the screen to bring up this option. Just click in there, and Crystal will give the providing questions, relating the questions to us, as we continue here. So we're glad you're attending today. Today, our topic is going to be on what you need to know about the Tax Cut and Jobs Act. This act here, I've been in this business for a few years, just a few. Don't you say anything, ladies. So this has been the biggest thing in my career since 1986. It's a major overhaul. It will affect every tax return that's filed this year. So what our plan today is just to touch on certain areas to give you an overview of how it can affect you, and as for planning is what we're looking at now, but obviously in the preparation of return. Gail and Karen, I don't know if in your years of experience, do you have anything to add to that as far as how over-encompassing this is?
I think you're right. It's been quite a number of years since every tax return has been touched.
Yeah.
Usually it's been one component or another, but as we'll see, everybody gets it this year.
Yeah, everybody's something. So, all right. So look at some things here, with the background, it was the law was signed by Trump, the major changes go into effect, this year. And again, as I mentioned, it's most sweeping tax legislation. Now, what has been frustrating from our standpoint, and I think frustrating is a good term, is that we have been kept in the dark as far as how to enforce or how to record some of these activities. When the temporary regs came out, maybe about 8 weeks or so ago, and they're just temporary regs. The final regs aren't going to be out until next year. So we're following temporary regs. Certain areas of these regs are at best very vague. So there's going to be various times that we're going to have to make assumptions on things. And we're just going to see, we're just going to go with what we feel based on our experience and the literature and everything that we do have to make sure this is recorded properly. But it is a little frustrating not knowing where certain things are going, but that's the space we live in today. So again, it's just look at the overview. Income tax rates have changed. The brackets have changed. The big thing here is there's a business pass-through option, which we talk about qualified business income, which we're going to talk about, changes to foreign income. And there's certain things when I'm talking to people about this tax act, I like to say, they give you some things over here and they take some things away over here. So there's going to be certain things that you're used to seeing in the past or used to taking advantage in the past, you're not going to have anymore. So we're going to look at things, but then here's some other advantages. So we're just going to cover some top items and top areas here that we think that you should be aware of. So what we have here, we do have, we're going to start with the individuals, and I think we want to start at, just the difference, in the tax rates. So Gail, if you just want to highlight some things here, we have the for single payers and married. So if you want to just cover some things here as far as what your observations are here.
I'd point out here that so that top tax bracket now is 37% compared to 39.6%.
Mm-hmm.
And you'll see that even some people that were in the 39.6% are now in the 35% tax bracket this year. What I'd point out here as well is that the kiddie tax has been adjusted or affected too. So kiddies or kids will be taxed on their earned income, the same as a single taxpayer at those rates. And their unearned income now is taxed at the trust and the state rates, which we don't have. But basically, it's the highest rates possible on unearned income.
Yeah, we don't. They will. What we do know is they will be high rates.
Yeah, and the benefit to that is that they no longer have to wait for their parents' tax returns to be complete. Same thing here. You'll see that the rate goes from 10% to 37%, and you know those 39.6. Some of them can see rates at 35%.
I think also this bracket here, this 22% bracket. Just these are the old income levels. I mean, they've expanded some things so once your income goes up, you can take advantage of some lower rates also, but it depends where you fall. And as far as capital gains,
so technically they didn't change there wasn't any changes to the capital gain tax rates. It's still 0, 15, or 20, but it's no longer, Rich, help me out with this, based on total taxable income, but
well, they changed it here. They used to say that, okay, hey, if you're in the 10% or 15% bracket, you didn't have any capital. The capital gains rate was 0. And
right.
Now it's looking at what your income is.
Yeah, so it's no longer based on the tax bracket you're in, but the income amount.
Right.
Okay.
Right.
And that is different.
Right, and you can see we're still at 0 to 15, and we did the introduction of the 20 rate when your income is over $480,000.
Basically, anyone in the 37% tax bracket is going to pay 20% cap gains.
Yeah, so it's still beneficial. I mean, a lot of times we'll talk to clients and they'll say, hey, capital gains, and they're all concerned about the capital gains they have. Well, if you're going to have your choice of income, ordinary or capital,
you still want capital.
You still want capital gains. Anyway, we can, yes.
So as this is the common area, everyone, I think, or maybe not everyone, but most people are aware that of the new standard deduction amounts of $12,000 and $24,000. Basically, anyone who was previously taking the standard deduction will probably see a decrease in their tax liability, but that's tough to say for large families. And just to add to this slide is there's no change to the additional deduction for the elderly or blind.
Okay. It's interesting with this $24,000 standard deduction for married filing joint. I was reading one report that they feel that this is going to eliminate a lot of the taxpayers out there that are filing that have itemized deductions. I think one statistic I read that only 6% of the returns out there now will have enough to itemize. So we'll see how
that definitely will make a drastic impact on who's itemizing, how many are itemizing.
Okay. Here the big thing that this is one of the things they take away, is that the personal exemptions are gone. So they give you a higher standard deduction, but the personal exemption, which last year was $4,050 per individual to return, that is eliminated now. I don't remember I don't know if you remember it off the top of your head, Gail, but I'm not sure. I forget what the income level was that once you reached a certain amount of income, these personal exemptions were phased out anyhow. So a lot of the higher incomes did not, they didn't get advantage of these personal exemptions anyway. But again, I think, we'll talk about some things coming up as far as the judicial credits, but the whole thing is, I mean, there is no personal exemption now. So that's been, ever since I've been in this business, we've always had some level of personal exemption. So this is completely new.
And essentially that increase in standard deduction, I think, from what I've heard, is if you have 2 kids, covers it, but any more than 2 kids, you're losing.
You're losing that part of it, right? So talk a little bit about the mortgage interest, because there's been some changes with this.
So the mortgage interest, basically you can deduct mortgage interest. There's a grandfather date of 12/15/2017. So anything that was in place before that qualifies for the limited interest deduction for the first $1 million of acquisition debt, which means it had to be used to buy, build, or improve your residence.
Yep.
Anything after 12/15/2017 is now limited to the first $750,000 of acquisition debt.
Right. And then, yeah, I mean, again, how many taxpayers that's going to affect for that loan. But I think what's key is how that, again, affects then the home equity interest.
I was going to say the bigger deal here is that the home equity interest is generally disallowed unless it was used to buy, build, or improve the residence. So, so unless it was used for that, it's not deductible anymore. It doesn't matter if it's existing or future. That applies to all open home equities in 2018.
So if I go out today and borrow on my home equity line of credit, you know, my lovely wife wants a new living room suite. So I go out and buy that to her, and I borrow my home equity line.
Non-deductible.
Non-deductible. But if she wants a kitchen addition, or I remodeled the kitchen, or whatever.
Rich, what if you attach that furniture to the ground? Is that part of the house?
is that a substantial improvement if you attach it? Well, and that might work in your household, but the way Edie moves things around our household, I mean, our furnitures get moved all the time, so that would not be a wise move for me.
All right, so non-deductible.
Nice try. Nice try. But again, you got to see things here: cars, vacations, anything. Now, what if I do this, Gail? What if I have an existing mortgage balance on I'm not talking about home equity here. I'm just talking about, I have an existing mortgage balance of $100,000, and I say, okay, fine, I'm going to refi, and I go out and I borrow $150,000 now, and I use that $50,000, to what we're saying here in the bottom bullet here. I purchase a car, or take a vacation. So my original mortgage was $100,000. I refi for $150,000, and I use that extra $50,000 for other personal items, non-house related to buy, build, or substantial improvements.
So your CPA is going to love you, because you now have to trace the interest, and you're going to have non-deductible interest on that $50,000, and you're going to have deductible interest on the $100,000.
Yeah.
And you want to make sure that you pay, as you pay it off, you can put it all towards the non-deductible portion first.
Yeah. So I think it's safe to say that, in this whole mortgage interest, home equity interest, et cetera, we're going to be requiring a lot more information than we have had to in the past.
Yes.
So when we get used to that, don't think we're just being nosy or anything like that. We need this information for these provisions. So. All right, so what's going on with the state and local tax deduction?
So that's capped at $10,000, and I kind of like to point out here some of the differences. If you're married or filing separate or single, it's $5,000. And this actually will, so first of all, keep in mind that this only impacts the people who can still itemize.
Right.
And it will then impact people who are paying, that this is your state and local income taxes. This is your real estate taxes, and for other states, we see here listed where you're paying personal property taxes. You're going to be limited to $10,000.
So basically, if I have a situation where I've had $15,000 of state and local income taxes in the previous years, or this is what normally happens, and I have $10,000 of real estate taxes, historically, I've been able to deduct that $25,000. But now I'm capped at $10,000. Correct. Right. So we have that. So basically, it's kind of consolidates some things, with our itemized deductions. But this is one of the areas where they take away.
Well, so what's interesting about this too is if you think about all a lot of those higher income taxpayers that might have been falling in alternative minimum tax. This is really just getting everyone to alternative minimum tax.
Yeah. Yeah. So it's, again, it's the give and take. So now here in our child tax credit, there's been some interesting changes on that.
So while we talked about that they took away the personal exemptions, but this is where they actually, again, they gave you some in that increased standard deduction, and they also give you the credit is now $2,000.
Where it used to be 1,000.
Yeah, and it substantially, and I think this is where I think it helps people, it substantially increases the phase-out threshold. So people who used to not get to take advantage of this credit at all should see some advantages to this.
Because that phased out fairly early.
It phased out fairly early, and now it's like 400,000.
400,000. I think you're right on that. So basically, so a lot of our taxpayers that have higher earnings there, they did not see the benefit of that $1,000 credit. Where now they're going to be seeing a $2,000 credit for any child under age 17.
Right, and the part of this one is the $500 credit for a child over 16 or any other dependent. So if you have parents living with you, you get some. Where you used to be able to claim them as a dependent, you're going to get a credit instead.
Credit for that, right. So again, the dependent's gone. We now get a credit. And just for everybody listening here, watching for us here, the difference between a credit and deduction. A deduction reduces your taxable income when you go to calculate your tax, where credit comes right off your tax. So just as we talked about, capital income is better than ordinary income, credits are going to be better than deductions. So, and then we do have this difference here where some of this credit can be refundable depending on where you're at.
Right.
And then we had the miscellaneous deductions.
So this really affects like the salespeople who do a lot of their own expenses and entertainment and building up their business. But basically, any of those unreimbursed employee expenses are no longer going to be allowed.
Right.
In addition to any of the other miscellaneous expenses like tax prep fees or investment fees and things like that.
And that has been completely eliminated.
Yeah. And so in those cases, those individuals should be looking to their employers to see if they can get reimbursed under an accountable plan.
Right.
And then the employer then at that point could take those deductions, assuming that they're ordinary necessary business expenses. So here I'd like to point out too that the overall limitation on itemized deductions has been eliminated too. So a lot of the higher income taxpayers used to see a decrease in what was allowed in their itemized deductions, and that has been eliminated too.
So just overall, when we're looking at these itemized deductions, I mean, we still have the medical provision there, but the medical provision is, this year it is 7.5% of income. Next year it goes up to 10% of income. So generally, people are not going to be able to take advantage of that medical. Now we still have, the next section we have on there would be our state and local income taxes and our real estate taxes. But again, that's phased out at $10,000.
Right.
Okay? Mortgage interest. A lot of taxpayers are not going to be affected by this change with mortgage interest.
I think the biggest impact there is going to be the home equity line of credit.
Home equity line of credit, and we're just, again, like we said, we're going to need more information on that.
Right.
And so, and also you have to remember, anything that you change afterwards, after these dates, I mean, that goes into effect. That is under new tax law.
Right.
And then we have our charitable contribution area. Now, do we have any planning tools that we can look at possibly? If I have a client that historically has had $20,000 worth of itemized deductions. And so now we know that, hey, that's under the $24,000 standard deduction. Do we have any planning tools that we possibly can give some advice here as far as what to do when they're historically around that $20,000 area?
I would say there's two planning tools with contributions that I like to recommend. The first one isn't necessarily a new tax law change, but it's the qualified charitable distribution, where if you're 70 and a half and required and taking required minimum distributions from your IRA, whether you're able to itemize or not, I strongly, and you make regular contributions to a particular organization, I would recommend that you consider making those contributions directly from your IRA. In that case, you would not have to pick up the income. That really could save you an income tax bracket, depending on what your contribution rate, amount is.
Now the key word there is directly.
Correct. It has to go directly from your IRA to the organization, 501c3 organization.
Right.
And it has to be an IRA. It can't be a pension plan or anything like that.
Right.
That's the first recommendation I look for. The other one here, which is geared towards these changes in the standard deduction, and would be if we have a lot of very charitable people in Lancaster County, and so if they're giving like $15,000 a year and they're either going to just barely itemize or they're going to miss the itemization, we could recommend that they consider bunching or their contributions and making kind of 2 years in one, doing it every other year, and so they can get the advantage of that charitable deduction. Right. I was looking at somebody, and so they were like eking out and getting $25,000 of itemized deductions this year. And so that really means that they were benefiting from their itemized deductions about $300 in tax dollars.
Right.
If they doubled up and their contributions were, let's say, $15,000 or $16,000, if they doubled up, they would get a benefit of about $3,500, I think.
Yeah. So what you're saying, I know. Okay, so I know my state and local income tax, real estate tax, they're capped at $10,000.
Yep.
Okay, so between mortgage interest, deductible mortgage interest, and charitable contributions, I have to have $14,000 or more to get above that standard deduction.
Right.
So if I have, let's say my mortgage is paid off, I don't have any mortgage interest, and I historically give, $12,000 a year to charities.
So you definitely want to consider doing the doubling up. And one way to do that without giving it directly to that charity all at once is to put it in what's called a donor advised funds, where you can make your you get the deduction for making a contribution, but those funds aren't necessarily dispersed until you identify. There's more specifics about all that, but
that's a good idea. That's a good idea. So, but I think it's key just to point out that, we're not, I always talk to my clients, a lot of my clients will say, hey, and I personally agree with them that basically, donations should not be tax motivated. I mean, it should be coming from, hey, this is how I feel, what I feel should do, et cetera. So we're not changing anything here. All we're doing is suggesting changing the timing.
Right. And then, so if you do that, then next year you're going to get the benefit of that $24,000 standard deduction, and it's actually a benefit then, because you've taken that contribution deduction and made it effective, more effective by doing it a little bit earlier.
No, I think that's good. So, all right. Next thing we have here then is what we're looking at here on this health insurance mandate.
Rich, I have a couple of other
go ahead.
items just to kind of bring up. The one, and this one gets lost a lot in these conversations, but I think it's interesting and important. But I want to remind people that excess, or tell them that excess bonus losses have changed too, where we used to be able to take net operating losses and carry them back. We can no longer do that. There's some calculations on how much you can utilize in that year. And then it's limited, and then you'd carry it forward.
So basically, what we had in the past, I mean, if you had a business or a net operating loss, I mean, factor with business, et cetera, we could carry it back 2 years, or we could carry it forward 20. That's old law.
Right. Carry forward. There's no cutoff. but there's no carryback anymore.
With no carryback, but there are calculations that we have to go through as far as calculating how much, if we have a large NOL, net operating loss carry forward, like you said, we would be limited on what we could do. You know, but so we have to go through that calculation to see how much we are allowed to have. Right.
Yeah, and again, I feel like that one kind of it's kind of it's been there, but it's been silent. Many people have been silent on that. So, and then the big one, which I'm sure people are kind of curious about, which we'll get into on the business side, is the deduction for the qualified business income. I think another interesting one was the alimony. Alimony and separate maintenance payments are not deductible by the payer and are no longer included in the income of the payee. But that again is for agreements executed before 2019.
Okay.
And I think we should have seen people be doing this already, the qualified tuition distributions. They expanded that to include elementary and secondary or private and religious schools.
Right, that's key too.
I think that's yeah.
I mean, historically, it has just been a credit that you got on second college education, basically.
Right.
But now they have opened that up for parochial schools, et cetera.
So yeah, those were just a few things that I thought I'd add to what we've already gone over.
I think that's good. All right, well, we have one other item here to cover, you know, on the individual taxes, and that's on our most favorite area, this health insurance mandate. And obviously being facetious on that. So there has been some confusion on this. I've talked to quite a few people that I've heard certain things that the health insurance mandate, the penalty, or no, I apologize, it's not called a penalty. What's it called? A shared responsibility payment?
Sounds like a penalty to me.
Sounds like it smells like a penalty, feels like it's anyhow. I didn't say that, but anyhow, that is still with us for 2018. There's a lot of people out there that have heard, hey, the health insurance mandate, the penalty isn't around anymore. That is still in effect for 18. But so we have a couple more months until we have the freedom, you know, from this. So, Crystal, do we have any questions that came in that need answered?
I have. How does the elimination of the miscellaneous deductions for individuals affect sole proprietors?
You want to handle that, Gail?
It really doesn't, because if they're ordinary necessary business expenses for a sole proprietor, they're taking those deductions on the Schedule C.
Right. Yeah, so what we're looking at, these would be your personal deductions. I mean, it's a good question, but it really does not, I mean, you know, we really don't have, and Karen, I mean, you can, we're going to be talking about the business area coming up here, but to my knowledge, there's some minor changes, you know, just as far as entertainment and some things like that, but as far as a sole proprietor, there's not many changes that's going to affect the calculation of their business profit.
Outside of depreciation and
which we're going to cover coming up.
Right, and the business entertainment. Yes, that's correct.
Okay.
Most everything else for sole proprietors has remained status quo.
Again, that miscellaneous itemized deduction we see mostly with sales reps who
are on a W-2, not necessarily a Schedule C.
Right, and also you mentioned something. I see the big changes that are going to affect these salespeople. You know, Gail, is going to be the ones that are not reimbursed for their automobile expense.
Right.
I mean, we have some clients that will come in here, will drive 30, 40, 50,000 miles a year, and you multiply that by the standard rate of 50-some cents a mile. Even, you know, they got a nice deduction. That's gone for them this year.
Well, I would also caution people, though, that it's gone for federal, and as far as we know, it's not gone for PA, though.
That's true. Good point.
PA is local. So I would encourage people to continue to keep those records, and you know, as long as it's not causing them, you know, too much hassle and the benefit is not too great, I think they should continue to keep the record.
Right, and I think also it would behoove them to go to their employer to get some type of accountable plan, that they will be reimbursed for that, even if it means taking a lower salary for that. You know, if I have
Absolutely.
$15,000 worth of expenses that I have not been reimbursed for, and you know, I'm not going to get any federal benefit from that now because it's eliminated. It would be beneficial for me to say, hey, fine, I'll take a $15,000 pay cut if you pay for these.
Actually, that's a great idea.
Yeah, yeah. I come up
Because
once in a while. I come up with them.
well, it's lower income, and quite
Yeah.
frankly, like it would be silly for them to do it dollar for dollar. But even if they did, the employer would save payroll taxes. They'd
Yeah,
save.
it's a win-win.
Right.
Yeah, on both sides, for the employer and the employee.
Hmm.
So if we have anybody out there that has that, you know, feel reach out to us on that. So.
And then the other question that
Yes.
came in, just to reiterate, the state and local tax deduction if single is $5,000.
Yes.
Yes.
Okay.
Yes.
Okay.
Okay.
Very good. Any other questions?
That's it for right now.
Okay. Okay. Very good. Then I think what we're going to do now is we're
Actually,
going to.
let me double check on that state and local.
Yeah, I'm not sure. I
It's
want to.
5,000
Yeah.
for married filing separate for sure, but let me
Yeah.
check single.
Well, go ahead. We're going to continue on, and when you find that, because we're going to let Karen share a little bit here, because we're going to move on to the effects on businesses, and what we have here, you know, as we switch gears, you know, from the individuals to the businesses. There's been some interesting changes, you know, on this that we're going to cover, and this is, I would say, some of the areas that we're going to be covering in business have the most mud, if you will, in the areas of this new tax law. Now, what we're starting out here is, you know, part of Trump's campaign platform was to reduce business taxes. And so what they did, so for the regular C, what we call C corporations that pay their own taxes, a lot of our clients are set up as S corporations, which has the income flowing through to the individual tax, into the individual return, where C corporation pays their rate. So what was it, Karen? What was it, the rates of what you had? Was it 15% on the first $50,000 worth of profit, 25% on the next 25,000 profit, and once you got to 75%, you were paying 35%. And I think there was even some things.
And there was actually a surcharge on top of that. It would hit a 39% bracket.
Right. So but it did not take you long to get up to 35%. Okay?
No, it did not.
Right. So what they did at the C level, at the C corporate level, they said, hey, fine, we're going to come across with a flat 21%. Okay. Personal Service Corporation could be 21%. That was a high rate also. And now we didn't see too much of this in the past, but you did have this alternative minimum tax. We brought that up a couple times today, and people that don't know what alternative minimum tax was, I forget the date. I think it was sometime in the 70s that came out, and it was just at that point in time, Congress felt that too many people were taking advantage of certain tax deductions, so they came out with a separate tax system, if you will, and we always had to go through a regular tax calculation, alternative minimum tax calculation, and whichever tax was higher is what they ended up paying. So that's gone at the corporate level. You might have heard some things. Now, we're going to be getting some things in here as far as I mentioned before about this qualified business income. So we're going to be talking about some things, but I just want to point out here, and we're talking a lot of things we're covering. Hey, this is a federal tax law. Okay, you know, Gail did bring some things up as far as the unreimbursed business expenses. Yeah, they're still eligible for Pennsylvania. I'm cautioning people to be careful on this, because I have read some articles as well. I'm sure Gail and Karen have also, that you know, is this the time, because of this flat 21%? Is this the time that the C corporation is resurrected? I mean, basically, the S corporation has taken over, has taken that space over years ago. But you have to realize that at the present time, Pennsylvania's corporate net income rate is 10%. So when you add these together, 21, 10, that 31%, that rate is not very appealing. So you got to be careful with that, but that is an option, but that's what thing. Now, later on, a few slides later, we're going to be talking about this qualified business income and how they tried to come up with a system that gives in our space our clients and the country's made up of these small businesses, and how there is some benefits that can be passed through them. So, but here the C corporate rate was dramatically reduced. And Karen, there's been some changes we talked a little bit about as far as the business entertainment. Has some items to share here.
Yeah, actually, I was at a seminar and the speaker said, basically anything that used to be fun is no longer deductible. So,
okay.
Which really, it pretty much sums it up. And again, I think what they're doing is they're taking away where there might have been some abuses in the past and trying to level the playing field a little bit. But I think the biggest thing that we can do to kind of help even this out a little bit is maybe it's being more conscious of your expense classifications.
Mm-hmm.
Where if you would have bought if you would have made a donation to a soccer club because your name is on the t-shirts, maybe that's more advertising than, a business entertainment expense.
Right.
So you might be seeing your chart of accounts get expanded a little bit so that we've got better classifications, because it will make a difference down the road. So basically anything that you were giving away, concert tickets, sporting events, that's all gone. And
what about taking a business associate out on the links out to play a little golf?
Well,
I guess does that come? Am I saying, hey, the way I don't golf, but the way I used to, I don't know if it was fun. So you're saying if it's not fun, I can deduct it. Is that what you're saying?
Yes, that's true.
It's not deductible.
Thank you, Gail. So we have things like that. We've come across certain things where these sporting events, you have your sky boxes, or you might buy season tickets to the Barnstormers and hand those out.
Correct. That's off the table now.
That qualifies as fun.
Yes, that would be fun.
Okay.
We're in a no fun zone.
No fun zone. Okay. What's going on with meals now?
Well, okay. So meals is probably one of those general ledger accounts where you're going to want to split out a little bit. Meals for entertainment are not deductible. Meals for employees for their benefit are now 50% deductible.
Mm-hmm.
Although by, I think it's 2025, that actually goes away.
It's gone. So
completely also.
Yeah. So what if I okay, so, last week I was down in Sarasota at a conference, the meals on that type of trip.
Okay, that would actually be deductible because it's directly related to a business meeting or a convention.
Mm-hmm.
So that would be something that you would put into that deductible meal account.
Right. Now, at what % benefit do I receive?
I do believe that's still at 50%.
50%, right.
For now. 2025, you won't get anything,
right.
But
so, okay.
Where it used to be 100%, you're now at least getting 50.
Now, what about if I have a client comes in here and we say, hey, look, it's lunchtime. Let's continue this meeting over lunch. And we go to a restaurant here, continue our meeting, and then go our separate ways.
I believe that is still 50% deductible.
That's my understanding,
right?
because it's part of the business. It's not entertainment.
Correct. Yes, you're
right.
still, if it's still a bona fide business purpose,
mm-hmm. Right.
then it still qualifies.
Now, I think the one that they really get a little bit deep here in splitting hairs, that coffee you buy for the office, any type of food for the office or anything like that, that used to be 100% deductible, now 50%.
So what are you saying? You're not buying us chocolate in tax season anymore?
I think it.
Now we are not having fun.
I was going to say, I think that would be I'd have mass mutiny if we wouldn't have chocolate in this office. So
you might just have to take the hit on that one.
yeah. So I think we're okay with that. We'll take the hit. So, so anything else on this business entertainment space?
No, like I said, I think the biggest thing is just being a little bit more conscientious of your classifications.
Yep.
And that'll make our job easier, and will give you hopefully a better deduction than if we consider it as all non-deductible.
Non-deductible, yeah. So, all right. Depreciation.
Oh, yay.
Mm-hmm.
I think probably the important thing here is to keep in mind what you had said earlier about there's a federal limit and there's a PA limit.
Mm-hmm.
And with Section 179 and bonus depreciation, which is coming up shortly, that's probably one of the biggest areas. So what makes sense for federal may or may not make sense for PA.
Yeah. And also, just to clarify, when we say Section 179, that's just a special depreciation that came under Code Section 179 that allows the write-off on the year of acquisition.
Correct.
Right. Okay.
Yeah. So, so for 2018 and forward, they're now allowing you $1 million of 179 write-off.
Mm-hmm.
Now that starts phasing out whenever you have $2.5 million of total acquisitions for the year. So federal gives you $1 million write-off. Pennsylvania gives you $25,000.
Yeah, I think there's some type of a disconnect there, but that's anyhow.
And actually, Pennsylvania is going to phase out at $200,000.
Yeah, right.
I believe it's $200,000.
Right.
So, but again, keep in mind Pennsylvania's tax rate is 3%.
Mm-hmm.
So, 179 will let you take it on new and used equipment, which used to be a big deal with the early versions of bonus depreciation, but as we'll see in a minute, that's kind of a non-issue anymore.
Right.
And it's for basically your shorter-lived equipment, not leasehold improvements or real estate, I guess I should say.
Right.
Whether it's residential or commercial.
Or commercial. So we're talking about the automobiles. We're talking about general construction equipment. We're talking about office equipment. Items like that. And we still have this de minimis, this minor amount of $2,500.
Yes. Yeah. It's still at $2,500.
So I go out and buy a computer for $1,500.
We would just actually leave that in office expense.
Right. It would not go.
Not even capitalize it, and it would not be included in that cost of acquisition, which is going to start maxing out at $2.5 million.
Right. Okay.
And that $2,500 is actually per item.
Right.
So if you buy 5 computers at $1,500, and boy, I should have picked an easier number. Let's say you buy 5 computers at $1,000. Better. So you have a total invoice of $5,000.
Mm-hmm.
The $2,500 write-off is actually per computer.
Right.
So we would still leave that $5,000 in office expense because you have 5 items.
Right. And that's one of the reasons a lot of times we will request copies of a purchase invoice, so we can see what's going on here and how to classify them properly.
Because at first blush, we're thinking you bought 1 computer for $5,000 that we would need to capitalize.
Right.
Whereas in actuality, you bought 5 at $1,000, and those we can just send straight to the bottom line.
Exactly. So, All right. So now we're going to move on. Or do you have something else with the
I do
179?
have one.
Okay. I'm sorry. Go ahead.
They have expanded this 179 to include lodging establishments, tangible property bought there.
Mm-hmm.
But so motels and hotels get the benefit of that, but it still does not include rental properties.
Okay. So if I go out and buy a $2,700 refrigerator for my rental property.
I'm sorry, we cannot take 179.
Okay. All right.
Because it's that rule is still in effect.
Okay. All right.
Okay.
On the depreciation theme, we now have a change in our bonus depreciation. So maybe just talk about what is bonus depreciation.
Well, bonus depreciation came into effect back in after 9/11, and it was to spur manufacturing here in the United States to keep things rolling. And so originally it was a 30% write-off of only new equipment because they wanted people to be ordering from factories. As time has progressed forward, it's become more and more convoluted, and now we're at the point where it's now on new and used property, and it's 100% write-off. So kind of what's the difference between that and 179?
Well, if I have if I go out and buy $3 million worth of equipment.
Well, for 179, it's going to phase out at $2.5 million.
Yeah. So
you're not going to get anything.
Right.
But with bonus, you can still take it.
And plus,
can't one of them? Excuse me. Sorry, before I forget.
Yeah.
One of them can create a loss, and one of them cannot.
Bonus can create the loss. With a loss, 179 is not eligible to be taken. Well, I should rephrase that. You can take it, but it will carry forward.
It's suspended, right?
Yes, it's suspended.
And I think another difference here is the type of property you can take bonus on compared to 179.
Well, like your rental property.
There you go. There you go. So basically, I buy this $2,700 refrigerator. I can't take Section 179 depreciation on it. I can't write it off there, but I can come over here and write it off as a bonus.
Correct. Yes.
Okay. And also for our farming clients, 20-year property down there at the bottom. 20-year property would be a bank barn. So I cannot take, if I go back here, I cannot take Section 179 on a bank barn because that's 20-year property, and then it only goes up to 10.
Correct.
But I can now, if I spend $100,000 on a bank barn, I can deduct the full $100,000 if I need to.
Correct. Yeah. Now there's a couple caveats with the bonus depreciation. So the 100% is now through 2022, which sounds like a long time off, but it's really not.
No, it's not.
After that, it starts phasing out at 20% each year. So by 2027, we're back to 0% bonus. But let's be realistic. We're going to have like 2 presidential elections between now and then. So we'll deal with that one later.
And that's a good point. I probably should have said this at the start. All these new tax law changes are only good through 2025. Then it reverts back to where we were last year. Last year.
Okay.
So.
Assuming we make it to 2025.
All right.
Another little caveat on the used part of this 100% bonus depreciation. It needs to be new to you. You cannot have had this asset in use prior to acquisition.
Okay.
It sounds kind of weird, but it would be perhaps like in a lease arrangement, lease to purchase.
Okay.
Okay.
Yep.
You can also not use any property that was acquired from a related party. So you and your brother can't be swapping hay wagons back and forth just so you can take bonus depreciation.
Okay.
And it also doesn't qualify on assets that have a step up in basis.
Okay.
So,
Okay.
and that gets to be a little tricky whenever you have partners coming and going.
Yeah. Okay.
I should mention that it is a mandatory election
Right.
that you have to take the bonus depreciation, but we can elect out
Right.
of it.
We collect out of it. Yes.
So it's kind of one of those goofy little things where you have to do it, but not really.
Mm-hmm.
Not if it's not beneficial.
Right. And I think also it's key to point out here, Karen, that there's a lot of areas. Okay, Gail was talking about earlier, when we're talking about the itemized deductions with bunching your contributions. That has to be done, signed, sealed, and delivered by December 31st. Okay. Now, when we get into the depreciation area, yeah, we have to have the asset, we have to have the piece of equipment placed in service by the end of the year.
Correct.
But we do not have to make this decision. How much Section 179 depreciation we're going to take, how much bonus depreciation, again, we can play around with this, if you will, post 12/31. And we can then find out with the rest of the taxpayer's picture, what is that sweet spot that we need to hit. I mean, we have a lot of planning with this.
Correct.
And if and whatever bonus depreciation we don't take, whatever Section 179 depreciation we don't take, then okay, so fine. If I have a $25,000 piece of equipment and we calculate the sweet spot that we need $20,000 worth of depreciation, well, that $5,000 would then be spread out over 3 years, 5 years, 7 years, whatever the life of that equipment would be.
Correct. Yeah, I mean the regular depreciation expense is not going away.
Right.
These are just accelerated methods to get a higher deduction if you need it.
Right, and that's key too. We don't go out and buy equipment just because we don't go out and spend money to save taxes. We don't buy the equipment unless we need it. Gail?
And I just want to be devil's advocate here, because that's my role.
I was going to say, I mean, some things never change,
So just keep in mind, we might not even want these deductions because we want to take advantage of this qualified business income deduction that we're all dying to hear about.
Dying to hear about. Well, okay.
Because you're always going to get this depreciation, you're always going to be able over time to recoup that investment in that property, whether it's in the first year or over the life of the asset. Mm-hmm. You're not always going to get this deduction.
Oh yeah, we don't. Yeah, right. So
anyway, just saying.
Is that a segue? Or do you have anything else on depreciation, Karen?
No, that was the perfect segue. We're just. Yep.
All right. Well, we'll go on here, and now we get into the deep mud of this tax act. As I mentioned before, okay, fine, we have this corporate rate, flat 21%. So what about all these other businesses so this is what they came up with, and I'm not going to read this slide here because it's just, it makes as much sense to, but basically, I think what you have to look at here, the general rule is that the plan was, what advantage can we give these smaller businesses that these big corporations are getting? And so they came up with this qualified business income area. And what that means is simply stating, if certain criteria are met, you will only be taxed on 80% of your business income. Now, you can see there's a lot of other criteria here. One key number to remember here is $315,000 for a married filing joint return of taxable income and $157,500 for a non-married return. If you're underneath that, then you get the full benefit. Now, I have to say this again, if you read, I'm not going to read all this, but it's a lesser of 20% of your taxable income or 20% of your qualified business income. And that's what Gail was alluding to. I mean, we can play with some things here. What's going to be better? Yeah, obviously, if we take a lot of depreciation, that's going to lower your taxable income. But could we be getting a larger exclusion by not taking as much depreciation as we normally would? So it's going to be interesting. We can do some calculations with this again to find that sweet spot. Now, again, it's the $315,000. It's per thing, but then if you look, if it's above that, then you can look at the first part of this slide here. Then we look at the W-2 wage, the wages paid through the business, and then also there's also a factor in here, with asset acquisition. And I'm not going to try to go through and explain that because well, put it this way. When I went to a seminar on the new tax law, they spent the whole morning and a little bit after lunch just covering this, and we don't have that kind of time today. So anyhow, we look at certain things here with that. Now, the question then is who qualifies for this deduction? And basically, you're looking at all trades and businesses except those classified as specified service trade or businesses. Now, the specified trade or businesses are listed there with health, law, accounting, et cetera, et cetera. So the majority of our clients are going to fall outside that realm that they would qualify. Now, what we also have to define is when we talk about all trades or businesses, rental properties can qualify for this. It all depends how the property is managed. If it's managed by, if you take care of it, or if you have a management service take care of it. So there's certain things we have to look at with that. So it is an area here that is broad. Not going to hold any punches with this. I mean, there's a lot of calculations that go with this. It is decided at the business level, and then it flows through to the business level. So if I have a partnership or an S corporation, all the tests, everything has to be provided detail on the K-1. For our clients that we do not do the business return, that we just get the K-1 to do their individual return, there's a lot more information that has to be disclosed on that K-1. If it is not, it specifically states in the code that if these numbers are not there, even though we might think we know what they are, if those numbers aren't specifically disclosed, it is zero. So if we get one of those K-1s, it's going to come back to you and say, hey, it's got to be prepared correctly because right now you're not getting benefits. So it is tested at the entity level and flows through to the individual level, and then we have to do various tests with that. So it is quite an involved calculation, and like I said, this is an area that there's certain things it's not clearly defined. I mean, certain areas are, but it is an interesting area. So we look at certain things here. This was saying about the $315,000 worth of taxable income. That if it's depends where it's at. If you're non-service versus service, you can see where certain things. But if you're under 315 or under, I guess, taxable income less than 315, then you're okay. But when you get more than that, there's a lot of phase outs, a lot of other calculations that have to be done. There's also this interesting, and I just put this in here just for your awareness. If you have a combination of losses and profits from different activities, each one of them has to be looked at separately, and the losses and they're carried for. I mean, there's a lot of convolution here. Is that a word, convolution?
It is now.
Okay, it is now. Thank you. But again, it's very involved. Now, at the end of the day, it's a nice benefit. I think for the majority of the clients' tax returns we work on here, we're going to see some nice benefits here of of having the ability to exclude either 20% of their business income or 20% of their taxable income, whichever is more, whichever is less, I guess I should say. There with that. So I don't know if you guys, Karen or Gail, if you have anything to add on that. It's other than it's a lot of mud.
It is a lot of mud, and I think probably the biggest thing to emphasize is the information coming out on the K-1. They were very explicit about if there's nothing in those boxes, it is zero.
Right.
So if we come back to you and say, this K-1 that you have in this partnership or whatever does not have this information and we suggest you go back to that preparer,
Mm-hmm.
it could take a little bit longer to get an amended K-1. So, but
Well,
I think in our opinion, yeah, our hands are tied, but
yeah.
it could be well worth possibly going on extension if that K-1's not amended in a timely fashion.
Exactly.
So yeah.
Yeah, I know. It's interesting. This is interesting.
I think also it's interesting about this too is it's kind of whether it applies or doesn't apply at the business level, all the information has to be compiled.
Yeah.
So
Yes.
regardless, there's time spent. That'll be interesting.
Yeah. I mean, hey, when we prepare a business return, and we have no idea, and we don't do some of the partners or the shareholders' individual taxes. Yeah, we might have a business that okay, well, okay, hey, fine. They're both he and she. They're both physicians. Their income's going to be too high. They're not going to take advantage of this. Whatever. We don't know what else is on the return. They could have some losses that reduce it from previous years. Net operating loss carry forwards, whatever the case might be. That it is eligible. So we have to calculate it. It's determined at the business level.
And I think also too, we might be coming back with some very specific questions to make sure that we are providing the correct information in those boxes. So information that we might not have needed in prior years, we might be
we're gonna need more
different
detail.
set of questions. Yes.
Especially when you get into the rental realm. There's just So anyhow, I guess we're going to work through this with you guys, and it's like I said, there's just a lot of detail to go through this. But the rewards, from what I'm seeing with the tax projections that we're doing, et cetera, Gail mentioned some things before as far as bunching. I mean, there's definitely advantages to be had with some of this extra work. So basically, Karen, anything with the health insurance for businesses? I talked about the insurance mandate for individuals is gone starting next year.
Yeah, on the business side of it, no, it's still the 50 full-time eligible employees and full-time employed employees.
Mm-hmm.
That's the cutoff. So.
Yep, full-time equivalents. Yep.
Equivalents. Thank you. I couldn't think of what the E was.
Okay.
Yeah,
so no change with businesses that have 50 or more full-time equivalent employees.
Yeah, I think their premium adjustments probably change enough for them on that point.
Okay. All right, going back to equipment. Trade-ins.
Section 1031. One of our favorite things to do here at Landis and Associates. So the change here is this still applies for real property only. Right. So the new part of this is equipment that we used to do this calculation on is actually no longer in play here.
So I think the most common example was a company vehicle or a company truck or whatever like that would be traded in on a new one.
Right, and so basically you were deferring any gain and rolling that into the cost of the new one, based on the book value that was still the undepreciated value that you still had on your books based on what they gave you for a trade-in, cost of the new. It was a calculation that we needed to run through. Whereas now it's going to be a little bit more cut and dry. And really, even though you're trading in, we are going to look at it as pretty much being an outright sale.
It's a sale. It's a sale.
So you'll be paying the gain on it up front. And this is actually probably the only example I can think of where federal and PA now come back in line.
They come back in line because Pennsylvania never recognized that in the past.
Correct. You were always recognizing it as an outright sale. And so now federal cut up to PA, we're such trendsetters. What can I say?
But at the end of the day, I don't see this being a big deal because yeah, we do have the gain to be recognized now, but we're going to have the depreciation that we can do to offset that gain anyhow.
Mhm.
So it's just going through the mechanics of how it's recorded, with this, and but at the end of the day, it should come out in the wash.
Right. But at this point too, we'll also actually need to, most emphatically, need to see the invoice.
Yep.
So that we can properly record the in and out of it.
Yep.
And not just what you would have had as cash out.
Right. And this covered all business. I mean, I know farming, trading equipment was big. I mean, the trucking industry, trading the rigs in, that's always been a big thing. And of course, a lot of times just with the automobiles, the business automobiles. But again, I think the depreciation flexibility is going to be, at the end of the day, it should be a non-issue. Just again, how it's recorded.
Right. And like I said, it's still, the like-kind exchange still applies to properties.
Right.
Real estate, yes.
Right.
Which is where you would have had the potential for really big numbers to come through. So.
Okay. All right. So Karen or Gail, do you have anything to add in our equipment realm? Or the equipment realm or business realm? I know we just touched some things, but any areas that need to be highlighted that we didn't cover yet?
Not in the business side.
Okay. All right. Well, Gail, no, I'll come back to that. Crystal, do you have any questions for us now?
I do. I have one. It says, give examples of equipment or other items that follow a 20-year depreciation schedule.
20-year life? Okay. Basically, the only one I can think of off the top of my head is in the farming realm, where you would have farm structures that would not be single-purpose agricultural structures. Example would be a bank barn, an implement shed, etc. Would be 20-year property. Can you ladies think of anything else?
That's usually the only one I've seen.
Yeah. I mean, that's strictly. So I guess what we want to say, the general rule of that is that that's going to be in the agricultural industry that would apply. Any other questions, Crystal?
That is it.
That is it. Do you have any questions we didn't answer, Crystal?
I'm letting you accountants do your thing.
Okay. Or I should ask you, do you have anything to add to this conversation?
I absolutely do not.
Okay.
So
yeah.
Trees or vine-bearing fruits or nuts are 20-year property.
Okay.
Just so you know.
Interesting. I can honestly say I did not know that. Okay. So if I have a Christmas trees would not.
Any tree.
But it'd be a fruit tree. Yeah. Okay.
Vine-bearing.
Okay. Well, Christmas trees would be raised to be resold, so that would not be in production. So okay. Okay. What did you find out about that? There's no other questions on the business realm. What did you find out about the state and local income tax?
So that limitation is the $10,000 applies to married filing joint and single and head of household, and the $5,000 limitation is for married filing separate.
So married filing separately is 5,000, but all other returns would be 10. Now, that makes sense.
Yeah.
I mean, yeah.
Two other things I thought of to point out. I think it's just wise to throw out there that people should not necessarily expect the same kind of refund or maybe the same amount due that they're used to with these changes.
Good point.
The federal tax withholding tables have been changed and adjusted to take into consideration some of these changes already. So they might find things significantly different than what they've been used to.
So what you're saying, they're now getting it in their paycheck.
Correct. They could be getting in their take home.
Right. Their take home, because I remember seeing a lot of articles back in February when it's changed. Hey, your take home should now be larger.
Yeah.
But what happens here? So what you're saying, tax returns that we might have in the past might have always got like a $2,000, $3,000 refund. Refund could be a lot smaller this year because they already got in their take home.
And in reality, that's what we really want. The idea is to owe less than $1,000 or get a refund of less than $1,000.
Yeah.
So the one last thing I'd like to add too is like, I think that there's been a lot of communication through the media and everything, how like this is going to simplify things and everything's going to be so much easier and we're going to file our taxes on a postcard. Well, that actually is true for a lot of people, but for the people that it's not true for, it complicates it.
It does. Yeah, no, I agree with you. It's one of those things. Yeah, tax. I've always told people tax simplification is an oxymoron.
Jumbo shrimp.
Yeah. So it is. Good point there. I mean, some returns it will make sense. I mean, we do have a smaller tax return that we're going to be working with this year. Okay.
With 7 schedules.
But it is a postcard return. And what does it have instead of having? I mean, what would we have before? Did we have like 70 lines? I think they cut it down to 20 some lines. But again, you have all these other supporting schedules that they then. So nothing's really changed. It's just on different forms. But again, just so everybody's aware, I mean, hey, if they have a child that has been used to filing a 1040 EZ, or if they return someone they know that was a simple return, they might do what was called the short form, the 1040A. Those forms have been eliminated, and we just have now one 1040 form, the postcard. So, okay. Anything else to add, Karen, Gail?
I think just reiterating what Gail said is, for some, it's going to be a piece of cake, and for others, it is so not. Yeah. So that's again, each return is going to have to stand on its own merit and see what needs to be done. But we are going to be looking at, we're staying on top of the stuff, so when we get the returns in, we can see how it affects each tax return we prepare. So. All right. Well, I know, hey, we just touched various areas of this new tax act. Hopefully we answered some of the questions that you had, but we probably gave you some more. So feel free to review our website. You can go to landiscpa.com, or you can reach out to us by phone at 717-735-0834 or email us at info@landiscpa.com. We'd be happy to help you out, answer the questions that you have. We have recorded this webinar, and we will be providing you a link to the video that you can review certain things if you want to go back and hear some of the things that we discussed. I'd like to thank Karen, Gail, and Crystal for participating today. And again, please don't hesitate to reach out to us if you need any assistance. So thanks again for attending. And from Landis Associates, we want to wish everybody, you and your family, a Merry Christmas.